Private equity deal values just hit 1.2 trillion and everyone is cheering. The big guys are back.
Bloated, not back. They are just writing massive checks for fewer assets. The middle market is completely dead.
Dead is harsh. I prefer resting.
Tell that to Mastercard. They are slashing 4% of their staff and quietly shopping that Nets unit they swore was their future.
That retreat is definitely spicy. So who is actually buying in this market? The rundown. So every banker I talked to this week is using the exact same letter to describe the market. It's a K-shaped recovery.
Which is just a polite way of saying the middle market is completely frozen over valuation gaps, while the mega cap buyers are out there throwing billion-dollar parties.
Exactly. Private equity deal values are up 54%. Average check size is pushing 900 million. They're only hunting elephants right now.
Speaking of elephants, Worthington Steel is officially dragging Kloeckner Co across the finish line. They're building a $9.5 billion North American steel behemoth, though they aren't projecting a close until the back half of 2026.
2 years for antitrust review on a steel deal. Shocking. But I'll push back on the middle market being totally dead. Look at Brighter swallowing up Panama Bakery Group.
The Spanish pastry guys.
Right, they're absorbing $695 million in turnover and 2,600 employees. That's a massive middle market play to absolutely dominate premium croissants.
But Nate, that isn't a financial sponsor taking a flyer on a mid-sized company. That's a pure strategic roll-up. Brighter is just buying market share because organic growth is too expensive right now.
Fair. A croissant monopoly is still a monopoly.
I prefer the Motorola Solutions deal. 675 million Canadian dollars for Bell Canada's land mobile radio networks.
Very sexy. Radios.
Don't laugh. 66% of advisors are screaming that recurring revenue is the only thing that matters for targets in 2026. You know what has incredibly sticky recurring revenue? Emergency radio contracts for utility trucks. It's bulletproof.
Okay, I see the vision. Meanwhile, creative planning is doing the classic wealth management land grab, buying UK-based MASECO Private Wealth, adding $5 billion in AUM. We should see the regulatory filings on that drop tomorrow.
I'm actually more interested in the corporate garage sales happening right now. Have you seen the internal gossip leaking out of Mastercard?
Oh, you mean the part where they're quietly trying to offload the Nets real-time payments unit while simultaneously slashing 4% of their global workforce?
That's the one. They spent billions building out that infrastructure, and now they're running for the exits.
We need to pull up their last 3 earnings calls because I guarantee the narrative shift there is going to give you whiplash. The big one. You look at the charts this week and the market is literally just a giant letter K.
A very top-heavy K. Deal values are up 36%, but it's almost entirely driven by billion-dollar mega deals. The middle market is flatlining over valuation gaps.
Private equity is throwing absolute weight around right now. Average transaction size is swelling to 890 million. Total PE deal value jumped 54% to 1.2 trillion. Trillion with a T.
Which brings us to Worthington Steel acquiring Kloeckner. $9.5 billion, creating a massive North American steel behemoth.
See, I love this deal. Classic old economy consolidation. Voices. Everyone is suddenly obsessed with the letter K. I'm reading a note from a major bank calling the M&A market distinctly K-shaped. The top end is flying, but the middle market is totally stuck in the mud over valuation gaps.
The data backs it up. Deal values are up 36% globally, but it's almost entirely mega deals over $1 billion. Private equity is driving the top arm of that K. PE deal values jumped 54% to 1.2 trillion.
1.2 trillion. My former colleagues are feasting. Average transaction sizes are pushing 900 million. If you're a middle market founder wanting an exit, you and your buyer are staring at each other across a massive canyon.
Right. And here's what really annoyed me in these advisory notes. They're saying a third of the 100 largest corporate transactions explicitly cite artificial intelligence as a core driver.
The ultimate strategic catalyst, their words, not mine.
Oh, come on. It's pure corporate theater. You buy a company for its robust financial visibility, which, by the way, 66% of bankers admit is the actual priority for 2026. You just slap the word AI on the press release so the market ignores the premium you paid.
I actually disagree with you here.
You think they're really buying for the AI?
I think the fear of missing out on AI is a genuine strategic catalyst. Even if the tech is half-baked, boards are terrified of being left behind. They'll overpay just for the option value. It's not just PR, it's a defensive strategy.
Paying a massive premium for a defensive buzzword is exactly why I don't miss tech journalism. But fine, I'll concede the fear is real.
The fear is very real. Speaking of defensive strategies, we need to talk about what's happening on the regulatory front tomorrow.
Yes, we're watching for antitrust updates on that $9.5 billion Worthington Steel and Kloeckner merger.
Plus the filings for creative planning swallowing MASECO Private Wealth. But before we get to the steel and the wealth managers, we have to talk about the internal drama and the real-time retreat at Mastercard. Spill the tea. So you're telling me it's just a total coincidence that Mastercard is reportedly shopping around its Net's real-time payments unit right as they announce a 4% global workforce cut?
Oh, it's definitely not a coincidence. Have you read the internal messaging? They're calling it an aggressive realignment of 2026 investment priorities.
Classic corporate theater. Aggressive realignment is just bankers speak for we bought something we don't know what to do with, and now someone has to pay for the mistake.
Exactly. They bought Nets specifically to own the infrastructure. Now they're quietly backing out of the room. It's a massive strategic retreat, Nate. They just won't admit it.
See, I actually respect the move. Cut the dead weight. The middle market is totally stagnant right now anyway. If you look at what buyers actually want for 2026, 2/3 of advisors are screaming about recurring revenue and absolute financial visibility. Nets was just dragging them down.
Are you seriously defending this? They spend a fortune on that infrastructure play. You don't just oops your way out of a core asset /4% of your staff and call it a strategic win.
I'm just saying they're clearing the deck for something else, probably AI. Have you seen the latest numbers? Roughly 1/3 of the top 100 corporate transactions are explicitly citing artificial intelligence as a core driver now. I guarantee Mastercard wants some of that action.
Right? Because slapping AI on a press release fixes everything. I swear, if I see one more payments giant buy an AI wrapper and call it a synergy, I'm going to lose my mind.
You love the synergies, Maya. Admit it.
I prefer actual strategy, which brings us to a real trend. Private equity deal values just jumped 54% to $1.2 trillion, almost entirely on massive megadeals.
The K-shaped recovery is real. The big guys are just eating the world.
Speaking of eating the world, Worthington Steel is trying to create a $9.5 billion North American behemoth with Kloeckner, but they still have to get past the regulators.
And those antitrust filings are exactly what we are tracking for tomorrow. Tomorrow's radar.
Tomorrow morning, I'm refreshing the SEC portal for those creative planning filings. Swallowing MASECO Private Wealth is a massive international play.
$5 billion in AUM crossing the pond, but honestly, my radar is locked on the Worthington Steel antitrust updates. They're building a $9.5 billion steel behemoth with Kloeckner.
Wait, you actually think regulators are going to sweat a steel merger? We're in a K-shaped market, Nate. The billion-dollar megadeals are sailing through while the middle market chokes on valuation gaps.
Steel is national security now, Maya. It's totally different. Look at their target close date. Second half of 2026. They know regulators will make this a miserable slog.
Okay, fair point on the timeline. Speaking of a miserable slog, did you catch the Mastercard gossip?
Shopping the Net's real-time payments unit?
Yep, plus a 4% global workforce cut.
Oh, come on. They bought that unit to be their absolute infrastructure crown jewel.
Apparently the crown got too heavy, which perfectly sets up our next deep dive on corporate buyer's remorse.